I'll put it this way, and I see this all the time, especially with investors who load up their portfolios with high-yield ETFs. If your portfolio is constantly in the red, year after year, tell me, how is that not a clear sign that you're losing money? Since when did being down become a good indication that you're making money? MSTY investors thought they were getting paid to hold an income machine that aims to track the price movement of one of the most explosive stocks of the decade. Instead, they're getting paid while their portfolio quietly bleeds out. Bitcoin's sitting at over $100,000. MicroStrategy's down about 30% in 3 months. And YieldMax's MSTY down more than 50% year to date, not including distributions, and it's sitting just above $10. Today, we're going to break down exactly what went wrong, why investors are finally dumping this fund, and what the smart move might be from here. If you invested $10,000 into MSTY at the start of the year, when it was trading around $27 a share, your capital has dropped a decent amount. Whether you reinvested those distributions or not, the truth is, you've made no gains this year. Now, you'll still hear investors online saying things like, I made $4,000 last week on MSTY, or MSTY paid me $3,000 last month. But when you step back and actually look at the numbers, those claims don't hold up. Total return, that's your capital plus your income, hasn't gone anywhere. In fact, it's negative. Investors are losing money, even as the payouts keep coming in, because those distributions are sent out monthly and now weekly since YieldMax switched to that model. It creates the illusion of constant profit. If all you're looking at is the cash showing up in your account every week, it feels like you're making money, but that doesn't mean you actually are. There are 3 main reasons MSTY has struggled so much this year, and once you hear them, the performance starts to make a lot more sense. Number 1 is MSTR dependency. MicroStrategy trades like a triple-levered Bitcoin ETF. When Bitcoin stalls or drops, MSTR craters. And because MSTY caps the upside but keeps the downside, that pain gets amplified. Option income depends on implied volatility, basically how wild the stock is expected to move. When that volatility drops, premiums shrink, and suddenly your 100% yield becomes 90, then 70, and then 40. MSTY's synthetic exposure and weekly distributions sound active, but they don't solve the underlying math problem. Option income can't offset long-term price decay when the underlying stock trends down or moves sideways. Even after the switch to weekly payouts, the damage continued. Price decline accelerated, premiums got thinner, and the fund is bleeding faster than it's earning. Investors have caught on, and sentiment has completely flipped. People are selling, and there are even talks of a reverse split coming if it breaks below $8, just to keep it tradable. Meanwhile, Bitcoin's been trading mostly sideways, and MSTR has dropped another 25% over the last 6 months. So while some investors are still holding, most of the big accounts, including a few who used to promote the ETF, have rotated into other weekly pay options. Let's take a step back and think about this rationally. If I were in the shoes of an MSTY investor right now, I'd be asking one simple question. What's the opportunity cost? Why stay in a product that's designed to consistently trail its own underlying asset while capping your upside at the same time? Sure, you're collecting those distributions every month. It feels good seeing cash hit the account, but in reality, your capital is quietly shrinking underneath. That's just capital erosion dressed up as yield. You've got a lot of things working against you. Opportunity cost, you're falling behind MSTR, and even Bitcoin itself. You get tax drag because most of those juicy yields are return of capital, which lowers your cost basis and sets you up for a bigger tax hit later. There is also fee drag because MSTY takes 1% every year in management fees. It's basically death by 1,000 distributions. If I were sitting on a position that's down 50% or more, I'd harvest the tax loss, take the deduction, and redeploy that capital into something with a real shot at compounding. That's not panic selling, that's just smart portfolio management. You could put that money to work in the next 2 months and get some decent return from it. Now, to be fair, there is one group that could justify holding. If you're all in on Bitcoin and you genuinely believe it's heading to 150,000 or beyond, then sure, MSTR will likely follow, and by extension, MSTY could eventually recover. In that scenario, if you're reinvesting those distributions, you might see a positive total return over time. Keyword is might. But let's be honest, that's a narrow path. You'd have to treat this more like a speculative income play than a core portfolio holding. MSTY's story is basically the same as ULTY's, high yields masking deeper decay. It's the same yield illusion we've seen across most of YieldMax's lineup, flashy payouts up front, but the total return just doesn't hold up once you account for price decline. This isn't about being negative, it's about being realistic. When your yield outpaces your total return, that's not sustainable income. That's financial gravity catching up. For investors looking for yield, there are better ways to do it. Funds with more balanced structures, or plain old dividend ETFs that grow both income and principal. Because at the end of the day, the goal isn't to chase yield, the goal is to build wealth. And right now, MSTY just isn't doing that. I've been in that exact situation before. I was down bad on a fund, watching it sink month after month, and honestly, I kept convincing myself it would bounce back. Then a friend gave me a simple piece of advice that changed everything. Stop waiting for recovery, look for strength. So I did. I pulled my money from that losing position and moved it into something with real momentum, something that was actually performing. And you know what? It paid off. The fund I left behind never recovered. If I'd stayed, I'd still be waiting for a comeback that never happened. Sometimes you have to be brutally honest with yourself. If your current position isn't working, sitting there hoping isn't a strategy, it's denial. You need to step back, plan an exit that puts you in a better spot, and execute. That's how you protect your capital and keep it working for you. I'll put it this way, and I see this all the time, especially with investors who load up their portfolios with high-yield ETFs. If your portfolio is constantly in the red, year after year, tell me, how is that not a clear sign that you're losing money? Since when did being down become a good indication that you're making money? At some point, it has to click. Some of these income ETFs aren't always building wealth. In many cases, they're quietly delaying it. They make you feel good with those steady payouts, but underneath, your capital's shrinking. Hopefully, more investors realize this sooner rather than later, before years of income end up costing them their long-term wealth. For current MSTY holders who are down this year and seeing shrinking weekly distributions, the primary concern shouldn't be whether to hold. Instead, focus on capital efficiency. What is the best alternative use for this money? The prudent strategy is to sell, capture the tax loss, and reallocate the funds. Prioritize investments that offer a more direct and probable path to a faster return, rather than remaining in MSTY while hoping for a significant, timely recovery in MSTR and Bitcoin, and hoping that MSTY captures some of that upside. If this breakdown gave you any value, don't forget to like, subscribe if you haven't already, and let us know in the comments if you are holding or selling. Thanks for watching, and hope to see you in the next one.